Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another Your Tax-Free Life podcast. I'm so excited to be here with you. This is episode number 90. So we're fast approaching episode 100. I'm going to have something very, very special in a few more weeks once we get to 100. But as always, I'm excited to be here with each and every one of you. I'm full of life. Today, my wife and I just got back from a very nice trip to Madrid, Spain, and we went to Toledo, and it was a business trip, so I did a little bit of business there, but most of the time we were having a good time, enjoying ourselves. We met a couple of clients that were there as well, so we spent some good quality time together. For those of you that have never been there, it's a beautiful, beautiful historical city. The people are extremely nice. The food is to die for. We kept sending pictures and putting pictures up on Facebook of, restaurants and taverns and food and drinking and wine. So our daughters basically said, "Hey, Mom and Dad, did you guys go to Europe just to go eat and drink?" And we said, "Yeah, that's pretty much what we did." But obviously I did do a little bit of business. So again, thanks very much for joining me today. Episode number 90 is going to be a short one, but it's going to be an interesting one. And I'm always trying to find ways to give each and every one of the episodes an interesting name for all of us, to kind of remember. And this one is called No Good Deed Ever Goes Unpunished. Now, for those of you that have been in business or you've had personal issues in your life, I'm sure that you have heard this saying of no good deed ever goes unpunished. But today I'm going to apply this saying to the financial side of the house, and we're going to be talking a little bit about taxes and the impact of taxes when it comes to retirement savings in your different tax-deferred bucket accounts. As you all know, the tax-deferred bucket accounts are those accounts that when you put the money in, the money goes in pre-tax, the money grows tax-deferred, but then when you pull it out, you'll have to pay taxes on not only on the contributions that you made, but also on the growth of those accounts. Now, the vast majority of Americans, a vast majority of the clients that I engage for the first time, they're making all kinds of contributions to their tax-deferred bucket. Many of my top clients have been maxing out the contributions to the tax-deferred bucket for many, many years because of the fact that they think that once they're retired, they're going to be in a lower tax bracket. And many a times, based on my experience, the vast majority of the times, that's not necessarily the case. Either you're going to stay at the same tax bracket that you were while you were working, or in many different ways, you may actually be in a much higher tax bracket. And we have had so many different podcasts talking about the future of taxation in the United States, our national debt, the unfunded liabilities, who happens to be in power and when, and all of those things are going to play a major role when it comes to your tax-deferred bucket. One of the worst things, and I'm going to give you an example, but one of the worst things that you will find in your tax-deferred bucket is that anytime that you make contributions to an IRA, to a 401k, to a 403b, to a pension, to a deferred compensation program, depending on what it is that you're doing, a KEO, that used to be one of the old plans, or a SEP, if you happen to be self-employed. Obviously, you kind of lose control of the assets, because at the end of the day, any money that you pull out prior to age 59 and a half, unless you borrow the money and you have the ability to borrow, and then you'll have to pay the money back with after-tax dollars anyway, so that can create a double taxation once you start taking distribution of the assets. But, if you take any money out prior to age 59 and a half, unless you haven't happened to meet one of those exigent circumstances, not only are you going to have to pay taxes on that distribution, but you're also going to have to pay a 10% penalty for premature distributions out of your qualified plans. Once you get to age 70 and a half, you have another rule that comes into play, which is your required minimum distribution, or your RMD, meaning that once you reach the age of 70 and a half, whether you need the money or not, the IRS and the government is going to force you to start taking money out. And if you don't take the minimum required distribution based on your age, not only are you going to have to pay taxes on the amount of distribution that you should have taken, but you didn't, but most important, you're going to have to pay an excise tax penalty equal to 50%. So the only time that you have any flexibility in a qualified plan, anywhere in a tax deferred bucket, would be between the ages of 59 and a half and 70 and a half. So there's only that 11-year window in your entire life in which you actually have the 3 C's, as I normally call it, the care, custody, and control of your assets. So I am going to give you a simple exercise that I think is going to bring forth to all of you listening to the call today the saying of no good deed ever goes unpunished. So traditionally, clients and Americans contribute to their retirement accounts through 401ks, IRAs, SEPs, thinking many a times that tax deferral is the way to go. However, I think it's important to make sure that all of you realize that if you're contributing to a plan, you're not saving on taxes. You're actually deferring taxes. And when you defer the tax, you're also deferring the tax liability. And I think we have talked many a times as to where we think tax liabilities are going to be at some point in time in the future. Obviously, they're going to be much higher than they are today. As a matter of fact, for the first time in tax history, I've been in the financial services industry for 30 years, but for the first time, I'm actually able to tell clients when taxes are going to go up in the future. And taxes will go up on January 1, 2026. And the reason for that is that the Tax Cuts and Jobs Act sunsets or terminates on December 31st, 2025. So when all of us wake up January 1 of 2026, we're definitely going to be in a higher tax bracket than where we are today under the law, under the old law. But most important, our deductions are going to be lower because the standard deduction will go back to where it was prior to the Tax Cuts and Jobs Act. So going along with the exercise that I'm about to share with you, let's say that you happen to be an average American and you're putting money away into one of these qualified plan accounts. So you're making contributions every year. Let's say you're 35 years of age. So you're making contributions of $6,000 a year into a pre-tax tax deferred bucket account, whether it's a 401k, IRA, or a SEP, or whatever it may be. Let's say that you happen to be in the 30% tax bracket. So that means that you're actually deferring $1,800 in taxes. So if you had not put that money, the $6,000, into your qualified plan and you would have kept it at a 30% tax bracket, you would have paid $1,800. So the way that most Americans think is that, well, if I don't have to pay those $1,800 of taxes, let's say in 2019, if I make that $6,000 contribution today, then that means that I am saving $1,800 of taxes. And that's not the real answer. The real answer is you're not saving anything. You're postponing the tax, and again, as I said previously, when you postpone the tax, you're also postponing the tax liability. What many of you and many Americans fail to understand is that what belongs to the IRS will always, always, always belong to the IRS. So in this exercise, you're putting away $6,000 a year. At 30%, you're actually deferring, or you think you're saving, $1,800 a year. And let's say that by the time that you retire, let's use a 7% linear interest rate on your investment. By the time that you retire, you would have a total account value of $606,438. So that's not bad. You put away $6,000 a year for 30 years. So that would have been $180,000 that you would have put away. So the rest of it, up to $606,438, would have been the growth, the compounded growth of your assets. So now, obviously, from a business perspective, you think that you may be sitting pretty. Now, also remember that if you take those $1,800 that you quote-unquote saved by not giving it to Uncle Sam in the year that you made that contribution, over a 30-year period, you actually saved, again, quote-unquote, or deferred $54,000 of taxes that you would have otherwise had to pay the IRS had you chosen not to put these $6,000 into any type of qualified plan and or tax deferred account, and you would have taken that money right off the bat without putting the money in. So in reality, over a 30-year period, you have $54,000. That pretty much basically what happened there is the IRS gave you a $54,000 loan for your ability to use their money and their taxes for your convenience. So far, so good. Now you enter retirement, so now you're 65 years of age, and you say to yourself, well, I guess I'm going to start taking $50,000 every year, plus whatever I get from my Social Security and or any other additional income, but I'm still going to be taking $50,000 a year out of this IRA or 401k, and I'm going to do that for the rest of my life. So let's say from age 65 to age 90, that could be one number, it could be 89 years of age, but until the day you die. So you're going to take $50,000 every single year. Again, if taxes were not to go up in the future, excuse me, and as we all know, there's a very, very high probability that taxes are going to have to double in the near future or our country is going to go bankrupt. But let's say that the tax bracket of 30% that you had during your working years will stay there throughout your retirement years. So you take $50,000 a year. After taxes, you're going to net $35,000, which means you would have paid $15,000 in taxes on that first year to the IRS for the use of those $50,000 that you withdrew from your IRA or 401k. Now, over a 30-year period of taking those $50,000 every single year, you would have paid the IRS in taxes at the 30% tax bracket without even considering the increase in taxation that everyone continues to talk about. You would have paid the IRS $345,000 in taxes. So, wait a minute. You deferred the tax liability every single year starting at age 35 when you started to put away $6,000 a year. And rather than paying the IRS those $1,800 every year, you chose to defer that money. So at the end of those 30 years, you actually deferred $54,000 of taxation to pay it later, hopefully at a reduced tax rate, which is never going to happen for most Americans. By the way, the only way any of us on this podcast will be in a lower tax bracket in retirement is if you have been a financial failure for your entire life. Otherwise, that's never going to happen to any of us on this call, and for most Americans, that's not going to be the case. So you deferred $54,000, but you ended up paying the IRS $345,000. Now you do the math. Who do you think won? Who do you think that you created the retirement plan for? Do you think you created that retirement plan for yourself? Or do you think that in many ways you created that retirement plan for the IRS? See, the IRS, they're very good with numbers. They have actuaries. They have people that understand future growth, compounding effect, because not only are your assets compounding every single year, depending on that 7% rate of return, but so are the taxes. See, remember what I said. What belongs to the IRS will always belong to the IRS. So that $1,800 every single year is also compounding at that 7%, except at that side, those $1,800 and the compounding effect year after year, it goes to the IRS side of the ledger, not yours. So when it comes to the total distribution, the IRS allow you to use $54,000 of their money in order for them to collect $345,000 of yours. Again, when you really start thinking about this through a telescopic view, as opposed to a microscopic view, you will notice that no good deed ever goes unpunished. So does that mean that you shouldn't make contributions to a qualified plan? Of course not. I mean, there's a right amount of money that you need to have in your tax deferred bucket, and if you do it the right way, then obviously you can get some tax planning you can have some tax planning done for you that will assist you in minimizing those tax liabilities. But the vast majority of Americans are not savvy enough to do any type of tax planning. But I do recommend that you need to continue to contribute to your tax deferred account up to a limited basis. Every other dollar that you have, other than 6 months of expenses that you would place in your taxable bucket, should all go into your tax-free bucket. So just to finalize this quick podcast, bear in mind that you actually paid the IRS 6.3 times in taxes the amount of money that you were actually able to save, or that they loaned you, which was $54,000. Remember, you paid them you saved $54,000 in taxes during the accumulation years, and then you paid them $345,000 during the distribution year. So I think it's apropos for all of us to truly understand tax planning, because tax planning is going to make a very big difference between success and failure in retirement. And by the way, that's keeping it at that 30% tax bracket, throughout your entire lifetime. What if taxes were to double? What if taxes were to go up 15, 20, 25, 30, 40%? Obviously, the $345 would now become $500,000 in taxes paid to the IRS on a savings, alleged savings, or postponement of $54,000. Again, I'm hoping that all of you have been able to enjoy this short podcast. I have a lot of stuff that I got to catch up with. As I always say, if you're interested in learning more about tax planning, or if you're interested in preparing for 2020 and you want to start doing some tax planning now in 2019, we're already in the fourth quarter, so now is the time to do tax planning. Please feel free to reach out to me. You can call me at area code 786-1042, or you can send me an email at Bert, B-E-R-T, at GablesTaxGroup.com, and I will be more than happy to schedule a 20-minute conference call or a video conference call with you at no cost or obligation. And always remember, as I always say at the end of every single podcast, my job and that of my firm is to kind of help you and your family kind of change the way that you see things. Because when you start changing the way that you see things, the things that you see change. So again, thanks once again for your time today, and I'll talk to you again next week. Take care. Bye-bye.